Welcome to the deep dive. Today, we're tackling nifty options trading in India. It's a market with, well, serious potential for capitalizing on market swings, but let's face it,
Yeah.
getting your head around the strategies, the tools, it can feel like trying to solve a Rubik's Cube blindfolded, especially if you're just starting out or, trying to get beyond the basics.
Absolutely.
So our goal in this deep dive, to bring some clarity, to simplify that complexity a bit.
Exactly. And look, we're not handing out hot tips or specific trades here.
Right.
Instead, we're going to dissect a structured approach for analyzing nifty options. We're drawing on the methodology shared by Mansi ma'am. Think of it as a practical guide, really, to looking at this market with a more, shall we say, informed eye.
Okay.
We'll assume you have some baseline understanding of options, and we want to give you a framework for, deeper analysis.
Okay, let's unpack this then. We'll be focusing on a core set of indicators. The put-call ratio, or PCR.
Yep.
Implied volatility for coloriferomity. The idea of max pain, synthetic futures, and of course the option Greeks. Delta, gamma, theta, vega. We'll touch on rho too, briefly.
Those are the big ones.
These are really the key pieces of the puzzle, right? The things traders often use. So first up, let's really get into the put-call ratio. What's it actually telling us about the market's mindset?
Okay, so the PCR. At its heart, it's actually quite simple. It compares the activity in put options versus call options.
Right.
And remember, puts are typically bets on the price going down nifty, in this case, while calls are bets on it going up. The PCR just gives us a ratio between those two.
So if the PCR is high, say above 1, does that just mean more puts are being bought or held? And what's the standard interpretation there?
Precisely. A PCR value over 1 generally means there's more activity or open interest in puts compared to calls. And yeah, the usual take is that this reflects a bearish sentiment.
Okay,
It suggests, more people are bracing for or betting on a downward move. Conversely, a PCR below 1 means more call activity. That points towards bullish sentiment, expecting a rise.
Like seeing more sunglasses sold in umbrellas maybe suggests sunny weather expected.
Kind of, yeah. It's a snapshot of whether the overall lean is towards expecting ups or downs.
Okay, I get that. Now, implied volatility 4. This one always feels a bit abstract. What's the main thing we need to grasp?
Right. 4. It's forward-looking. That's key. Unlike historical volatility, which looks back at past swings.
How much it did move.
Exactly. 4 is derived from current option prices, and it represents the market's expectation of how much the Nifty might swing in the future over the life of that option.
So it's a forecast of volatility.
It's like the market's collective guess about how wild the ride might get.
And how do we interpret high versus low 4E? What's the market signaling?
Well, high 4 suggests the market expects big price swings. You often see this spike around uncertain events, think major policy announcements, election results, that sort of thing.
Okay.
And when a FI is high, options tend to get more expensive because there's a higher perceived chance of a big move happening.
Right. The potential payoff is seen as larger, so the ticket costs more.
Exactly. And on the flip side, low IV suggests an expectation of smaller moves, maybe a calmer period. Options are generally cheaper then.
Interesting. High anticipation equals expensive options. Got it. Now, max pain sounds dramatic. What's the idea behind that?
It does sound a bit intense. Max pain is basically the strike price where the largest number of options, contracts, both puts and calls combined, would expire worthless.
Worthless for the buyers, you mean?
Yes, for the buyers, it's maximum financial pain, collectively. But for the option sellers, especially the big players who write lots of contracts.
The institutions.
Right. For them, it's theoretically the price where they'd suffer the least amount of net loss at expiry.
So is the theory that the market somehow gets pushed towards this price as expiry gets closer?
Well, that's the debated part. Some traders do believe the Nifty might gravitate towards the max pain level as expiry nears. Not necessarily manipulation, but maybe a result of large option writers adjusting their positions to manage risk.
Trying to steer it towards where they lose the least.
Potentially, yes. Or where the options they sold expire worthless. For a buyer, knowing the max pain point can be useful, maybe as a potential price magnet or a hurdle as expiry looms.
Okay, so a potential equilibrium point near expiry. Interesting. Let's talk synthetic futures. Sounds like we're building something.
Yeah, like financial Lego. A synthetic future is basically a way to mimic the price behavior of a regular Nifty futures contract. You do it by combining specific options. Typically, you buy a call and sell a put, both at the same strike price and with the same expiry date.
Okay, buy a call, sell a put, same strike. And why? Look at the synthetic price. What does it tell us?
Well, The price of this synthetic combo can give you a sense of the sentiment embedded within the options market, specifically at that strike.
Hmm.
By comparing the synthetic future price to the actual Nifty futures price, you might spot discrepancies or get a hint about whether option traders expect the Nifty to move higher or lower than where the futures market is currently priced.
Interesting, like a directional clue coming directly from the options themselves.
Okay, right, let's tackle the Greeks. These often feel like the really technical bit.
They can seem intimidating, yeah, but really, the Greeks are just measures. They tell you how an options price is expected to react to different factors changing.
Like sensitivity measures.
Exactly. Let's break down the main ones. Delta is probably the most straightforward. It tells you roughly how much the options price should move for every 1 point move in the Nifty itself.
Okay.
So a call option with a delta of, say, 0.6. If Nifty goes up by 1 rupee, the option price should theoretically go up by about 60 paise.
Got it. Immediate link to Nifty's movement. What about gamma?
Gamma measures how much the delta itself changes for every 1 point move in the Nifty.
So the speed of the delta change.
You could think of it that way, yeah.
Yeah.
It's the rate of change of delta. Gamma gets really important near expiry, especially for options that are close to the current Nifty price, the at-the-money options.
Why though?
Because in those situations, even a small Nifty move can cause a big rapid shift in the options delta. Gamma tells you how sensitive delta is to those moves.
Sounds like it could amplify things, make prices jump around more as expiry gets close.
Precisely. It adds another layer of volatility to the options price behavior. Now, theta. This one. Option buyers don't like theta.
Because that's the time decay, right?
Yeah.
The value just melts away.
Exactly. Theta quantifies that daily decrease in an option's value, purely due to time passing. All else being equal, as expiry gets closer, the time value just bleeds out.
So time is working against you if you're holding an option.
It is.
Eh.
But if you sold the option...
Then theta is your friend.
Exactly. Time decay works in your favor as a seller.
Okay. What about Vega?
Vega measures how sensitive an option's price is to changes in implied volatility, the 4V we talked about earlier.
Ah, the link to expected future swings.
Right. So if an option has a Vega of, say, 10,
Okay.
it means for every 1% increase in IV, the option's price is expected to go up by about euro and down by euro if IV falls by 1%.
So buyers like Vega because rising volatility boosts their options price.
Generally, yes. Positive Vega benefits buyers if IV rises. Sellers, conversely, usually have negative Vega, so they benefit if IV falls after they've sold.
Makes sense. And Rho, you mentioned it's less critical for short-term Nifty trades.
That's generally true. Rho measures sensitivity to interest rate changes. For weekly or even monthly Nifty options, the impact of typical interest rate fluctuations is usually pretty small compared to delta, gamma, theta, and vega. So yeah, most short-term traders don't focus heavily on it.
All right, we've got a handle on the tools now. Let's get practical. Mansi Mam's tutorial emphasizes gathering the right data for Nifty. What are the key pieces we need?
Okay, so for our walkthrough, let's set a baseline. Assume the current Nifty spot price is around 24,000.
Okay, 24K.
We'll look at weekly expiry options, maybe with just 3 days left until they expire. And crucially, remember the Nifty lot size is 75 units.
Right, 75.
The tutorial points out, and it's true, this data is pretty easy to find. You can get it from the NSE website itself.
The official source.
Yeah, or your trading platform brokers like Zero to Upstocks, they all show it. And then there are specialized options tools like Sensible, which aggregate a lot of this data, like PCR, IV, even Max Payne calculations, often in real time.
So the data is accessible. Okay, we have it. Step 3 is analyzing PCR for market sentiment. You mentioned OI PCR and volume PCR. What's the difference and why look at both?
That's the question. Open interest, or OI PCR, compares the total number of outstanding put contracts to outstanding call contracts. It gives you a feel for the overall positioning, maybe the slightly longer-term sentiment of people holding positions.
The accumulated bets?
Kinda, yeah. Volume PCR, though, looks at the ratio of puts traded versus calls traded during a specific session, like today.
So more about current activity.
Exactly. It reflects the immediate sentiment, what people are doing right now.
The example data has OI PCR at 1.2 and volume PCR at 0.8. That seems contradictory. 1.2 is bearish, 0.8 is bullish.
Ah, that's a great observation. And it's not uncommon to see that kind of divergence. It can be really informative.
How so?
Well, an OI PCR of 1.2 suggests that overall, the existing positions are leaning bearish. More puts are being held. But a volume PCR of 0.8 tells you that in recent trading, more calls were actually changing hands than puts.
So maybe new money coming in is bullish, even if older positions are bearish?
That's one interpretation, yeah. It could mean that while the established view is cautious or bearish, there's a recent surge in bullish trading activity. It really highlights why looking at both is important. You get the context of existing positions and the flow of current trading.
Right. It paints a richer picture than just one number. The tutorial then talks about using PCR in two ways, as a contrarian signal and for trend confirmation. Can you explain those?
Sure. The contrarian view looks at extremes. If PCR gets really high, say 1.5 or even more.
Everyone's bearish.
Right. The contrarian idea is that maybe sentiment has become too bearish. Perhaps there's nobody left to sell, and the market might be due for a bounce and upward turn as shorts cover.
So bet against the extreme crowd.
That's the essence of it. Conversely, using PCR for trend confirmation means looking for agreement. If the Nifty price is already rising and you see a low PCR, maybe zero point 0.7 or lower,
Lots of call buying.
yes, that could reinforce the bullish trend. It suggests participants are actively betting on the rise continuing.
Okay. And let's apply this. Our example, OIPCR 1.2, bearish overall. But Nifty is near a support level, say 23,800. What's a possible trade thought here?
Well, with that higher OIPCR suggesting background bearishness but the price holding at support, a contrarian might think, okay, maybe the bears are running out of steam here at support.
Potential downs.
Exactly. So you might consider looking for bullish trades, maybe buying call options, or perhaps selling put options below that 23,800 support level, anticipating the Nifty holds or moves up from there.
Okay, that shows how PCR can feed into a specific idea. Let's shift to implied volatility in step 4. The tutorial stresses looking at IV for at-the-money options. Why ATM specifically?
Good point. At the money options, those with strike prices closest to the current Nifty price, like 24,000 in our example, tend to be the most heavily traded. They have the most liquidity.
Right.
So their 5E levels often give you a pretty good barometer of the market's general short-term volatility expectation for the whole index. Plus, they tend to be the most sensitive to changes in both the Nifty price and overall market volatility.
We have example IVs, 20% high and 10% low. But how do we know if 20% is truly high or 10% is low? The tutorial mentions comparing to historical volatility.
That's the key comparison, absolutely. You need context. So if the current ATM IV is 20%, but Nifty's historical volatility over, say, the last month to 3 months has typically been around 15%.
Then 20% is high relative to the norm.
Exactly. It suggests options are relatively expensive right now, probably reflecting increased uncertainty or anticipation. But if IV is 10%, and historical vol is usually 15% or 18%, then 10% looks low. Options are comparatively cheap.
And how does knowing if IV is high or low guide our trading strategies?
Well, generally speaking, high IV environments can favor option sellers.
Because the premiums are juicy.
Precisely. Premiums are inflated. So strategies that profit if IV falls, like selling a straddle, which is selling both a call and a put at the same strike.
Like 24,000.
Right. Those can be attractive. You aim to collect a high premium and hope IV drops back down, maybe after an event passes. Plus, you benefit from time decay, theta.
Okay. And low IV.
Low 5E environments might lean towards option buying since options are cheaper.
Less upfront cost.
Yes. Buying strategies like just buying a call if you're bullish become more appealing, especially if you think a big move might be coming that could cause IV to spike up, increasing your options value further.
So high IV would maybe sell, low IV maybe buy. Got it. The tutorial gives specifics. 5E at 20% before a big event suggests selling options. Why is that the logic?
Because 5E often gets pumped up before uncertain events, right? The market prices in the what if.
Fear or anticipation premium.
Exactly. Once the event happens, the news is out, uncertainty tends to resolve, and 5E often falls sharply. This is called IV crush. So by selling options before the event, when the premium is high due to that pumped-up IV, you're positioning yourself to potentially profit from that expected IV crush afterwards.
Makes sense. And the other case, 5E is low at 10%, Nifty's stuck in a range. Suggestion is to buy a straddle. Why?
Well, low 5E and a tight trading range often mean the market is coiled up, maybe building energy for a breakout.
Could go either way, but likely to move soon.
That's the bet. By buying a straddle, buying both a call and a put at the same strike when IV is low, you're paying less for it. You don't need to know the direction of the breakout.
Just that it happens.
Right. If Nifty makes a big move up, your call option pays off. If it breaks down sharply, your put option pays off. And if the move is big enough, the gain on one side should hopefully outweigh the cost of both options, especially if IV also expands during the breakout.
Got it. Positioned for a move, any move when things look too quiet. Okay, let's tackle max pain in step 5. Example. Max pain is 24,000. Nifty's trading higher at 24,200. What might that imply?
Okay, so if max pain is calculated at 24,000, that's the level where option sellers collectively stand to lose the least if Nifty closes there at expiry.
Right.
If Nifty is currently above that at 24,200, it suggests that for those sellers to reach their optimal outcome, the price would need to come down towards 24,000.
So there might be some pressure pushing it down.
Potentially. You might see some selling pressure or positioning adjustments from large players trying to nudge the index closer to that max pain level as expiry approaches. It acts like a potential gravitational point.
So observing Nifty at 24,200 with max pain at 24,000, what kind of trades might someone consider based on that?
Well, if you believe in the max pain theory, you might think Nifty will struggle to stay significantly above 24,000. So one idea could be selling call options at strikes above 24,200, betting against a further rise. Or you might consider selling put options at strikes below the max pain level, say 23,900 or even 24,000 itself, anticipating that the price is likely to remain at or above 24,000. Your exact choice depends on your overall view and risk appetite.
The specific hypothetical action given is selling 24,000 puts if Nifty is at 24,200 and max pain is 24,000. That aligns with expecting Nifty to stay above or gravitate towards 24K.
Exactly. By selling the 24,000 puts in that scenario, you're essentially betting that Nifty won't fall below 24,000 by expiry. If it stays above, the puts expire worthless, and you keep the premium.
But there's risk if it drops hard.
Absolutely. Selling naked puts carries significant risk if the market moves sharply against you. So, proper risk management, like setting stop losses or using spreads, is crucial.
Always. Okay, step 6. Using synthetic futures for direction. We build one, buying a call, selling a put, same strike. Example, the synthetic price is 24,050. Spot is 24,000. What's the potential signal?
If the synthetic future created from the 24,000 strike options is priced at 24,050, while the spot Nifty is at 24,000, it suggests that the options market, at that specific strike, is pricing in a slight upward bias.
Like the options imply Nifty should be a bit higher?
Yeah, it's like an implied forecast embedded in the option prices for where the underlying might be around expiry.
And how do we use this? The tutorial says compare it to the actual Nifty futures price. Why that comparison?
Comparing the synthetic future price, say 24,050, to the actual traded Nifty futures price, maybe it's 24,030, can reveal subtle differences in expectation between the options market and the futures market.
What kind of differences?
If the synthetic price is consistently higher than the actual futures price, it might signal a stronger bullish undercurrent in the options market for that expiry. It could be seen as reinforcing a bullish outlook. If it's lower, maybe a bearish hint. Sometimes large discrepancies might even point to short-term arbitrage, though that's more complex.
Okay. The specific action suggested. Synthetic shows 24,050. PCR is also low, bullish. This combination points towards buying 24,000 calls. How do they reinforce each other?
Well, you've got two different indicators pointing the same way. Low PCR suggests general bullish sentiment or activity.
All right.
And the synthetic future price being above the spot price adds another layer, suggesting the options market itself anticipates a move above 24,000. When you get that kind of confirmation from different angles,
it builds conviction.
Exactly. It can give you more confidence in taking that bullish trade, like buying the 24,000 call, expecting that upward move.
Okay, looking for that alignment. Let's move to step 7. Applying the Greeks for trade management. We know what they are, but how do we use them actively? Let's start with delta practically.
Okay, delta. If you think Nifty's going up, you want an option whose price goes up significantly with it, so you'd buy a call option with a higher delta, maybe closer to 1.
Like an in-the-money call.
Or at the money. They have higher deltas, usually 0.5 or more. So for every point Nifty rises, your option gains more value. Conversely, if you're more neutral, maybe selling options, you might prefer lower delta options further out of the money.
Why?
Because their price is less sensitive to small, nifty moves. They won't move into the money as quickly if the market just wobbles a bit. So bullish, higher delta call, neutral. Maybe sell lower delta options or manage the net delta of a strategy like a straddle to be near zero.
Got it. And gamma, how does that play into managing the trade?
Gamma risk management is key, especially near expiry. High gamma means your delta can change fast.
Right, the sensitivity itself is sensitive.
Exactly. So if you're holding an option with high gamma and Nifty is bouncing around the strike price, your position's value can swing wildly and unpredictably because the delta is jumping all over the place.
Sounds stressful.
It can be. So some traders, if they see gamma getting very high on their ATM options near expiry, might actually reduce their position size or roll to a strike further out of the money where gamma is typically lower, just to smooth out the ride and have a more stable delta exposure.
So watch out for high gamma, especially near the end. What about theta? How do we actively manage with time decay?
Well, if you bought an option, theta is the enemy, right? It's that daily cost of holding.
The clock is ticking.
It is.
Yeah.
So if you bought a call expecting a move, and a couple of days pass, Nifty hasn't moved, you need to factor in that theta loss. Maybe your stop loss needs to be adjusted, or maybe you decide to cut the trade sooner rather than later because time decay is eating away at your potential profit even if Nifty eventually moves.
Don't let theta bleed you dry.
Right, but if you sold options, theta is working for you. As expiry gets closer, that decay accelerates. So if your view is playing out, Nifty isn't moving against you too much, you might deliberately hold the short auction position longer to capture more of that accelerated data decay in the last few days.
Okay, use the clock depending on whether you bought or sold. Now, Vega and active management.
Vega tracks sensitivity to IV changes. So if you bought an option when IV was low,
Hoping for a breakout.
right, and then maybe Nifty starts moving and IV begins to spike up, that rising 4, because of positive Vega, will add extra value to your option, on top of any gains from Delta.
The bonus.
Exactly. Seeing that IV spike might be your signal to take profits, capturing both the Delta gain and the Vega gain. Conversely, if you sold options when 5E was high,
Hoping for the 5E crush.
yes, and then after the event IV starts dropping as expected, your short option position benefits from this. Negative Vega means falling IV helps you. You'd monitor that IV drop and decide when to close the trade to lock in those Vega-related profits. It's about seeing if IV changes are helping or hurting your existing position.
And Ro, just to confirm, still mostly on the sidelines for these short-term trades.
Yeah, generally. Unless there's a really dramatic, unexpected change in interest rates, its impact on weekly Nifty options is usually minimal compared to the other Greeks. We can mostly set it aside for this kind of trading.
All right, this is really starting to connect. Step 8. Building a trade strategy by combining these. Let's revisit that sample scenario.
Okay, the setup was Nifty spot 24,000, PCR 0.8, that's bullish. IV 12%, pretty low, so options are relatively cheap. Max pain at 24,000 suggests potential support or a magnet there. Synthetic futures at 24,050, another slight bullish hint.
And this specific option?
The 24,000 call option. Delta 0.5, theta -5, losing 5 per day. Vega 10, gains value if 5E rises.
Okay. The proposed strategy is buy this 24,000 call. Why does this combo make sense?
Because you have multiple signals aligning bullishly. Low PCR, bullish synthetic future, Nifty sitting right at the max pain level, which could act as support. Plus the low IV makes buying the call relatively inexpensive.
And the Vega?
The positive Vega, 10, means if Nifty does start moving up and IV potentially increases, you get an extra kicker to the option's price. So it's a confluence of factors pointing towards buying the call.
And crucially, how do we manage the risk on this specific trade?
Right, risk management. The tutorial suggests a few things. First, a clear stop loss. If Nifty falls below 23,900, get out, because the bullish thesis might be breaking down.
Okay.
Second, maybe a profit-taking trigger based on IV. If IV spikes up to, say, 18%, perhaps you lock in the Vega gains even if Nifty hasn't hit your full price target.
Interesting.
And third, be very aware of that theta of -5. It's costing you 5 per day per option, or 375 per lot. If Nifty just sits there for 2 days, you've lost 10 in time value. So plan to exit if the expected move doesn't materialize reasonably quickly.
Time is money, literally here. The tutorial also offers an alternative. Neutral outlook, high IV, sell a straddle. Remind us of that logic.
Sure, if IV is high, maybe 20% or more, options are expensive. If you don't have a strong directional bias, PCR isn't clearly bullish or bearish, synthetics are flat, selling a straddle at the current strike, like 24,000, can make sense.
Oh.
You collect that rich premium from selling both the call and the put. Your bet is that IV will fall, the IV crush, and/or that Nifty will stay relatively close to 24,000, allowing both options to decay in value due to theta. You profit if Nifty doesn't make a huge move in either direction.
So betting on volatility dropping and/or range-bound movement. Okay, different tools for different jobs. Step 9 is all about monitoring and adjusting after you've put the trade on. What needs watching?
It's definitely not set and forget. You need to keep tracking these indicators. Watch the PCR. If you bought a call, bullish, and suddenly PCR starts shooting up towards 1.2 or higher.
Sentiment turning bearish.
Right, that's a warning sign. Maybe tighten your stop loss, maybe hedge by buying a put. Keep an eye on IV. If you bought options and IV surges, maybe take some profit off the table.
Lock in the Vega game.
Exactly. Monitor max pain. Does it shift as expiry nears? A big shift could change the dynamics. And regularly check the Greeks of your specific option position. Did your delta shoot up because Nifty moved? Maybe your risk exposure is now bigger than you wanted.
Need to reevaluate position size.
Potentially. And finally, stick to your exit plan. Know your profit target, know your max loss, and know by when you want to be out, especially considering theta.
Continuous monitoring and adjustment. Got it. Let's nail this down with the practical example in step 10. May 21st, 2025, 3 days to expiry. Walk us through this trade.
Okay, scenario. Nifty spot, 24,000. PCR, 0.7, bullish. IV, 10% low. Max pain, 24,000. Synthetics, 24,050. We're looking at 24,000 call up, priced 150. Delta 0.5, theta minus 5, Vega 10.
Oh, it's pretty bullish. Options are cheap.
Seems that way. So the action, buy one lot, 75 units of the Nifty 24,000 call at 150 per unit.
Total cost.
150 times 75 units. That's 11,250 outlay.
Okay. What's the goal?
The target is for Nifty to rise, say, to 24,200. With a delta of 0.5 plus maybe a bit of IV pickup, the call option price might increase to around 250.
And the stop loss.
So if Nifty falls to 23,900, at that point the call option might drop to maybe 100.
So let's quantify the risk and reward here.
Okay, potential risk. If it hits the stop at euro 100, you bought at euro 50, so that's a 50 loss per unit times 75 units. 2,750 risk.
And potential reward.
If it hits the target at euro 50, you bought at euro 150, that's 100 gain per unit times 75 units. 7,500 potential reward.
Okay. Clear risk reward defined. And that theta warning again.
Absolutely crucial here. Losing euro of 5 per day or 375 per lot per day. With only 3 days left, that decay is significant. If Nifty doesn't start moving up pretty quickly, that time decay will seriously eat into potential profits or increase losses. You can't just sit on it hoping.
Got it. Active management needed. Okay, finally, the tutorial wraps up with some key tips for beginners venturing into this type of analysis. Let's quickly recap those.
Yeah, essential advice. First, start small. Trade just one lot. Focus on simpler strategies initially, like just buying a call or put, to understand the dynamics before getting into complex spreads.
Don't bite off more than you can chew.
Exactly. Second, use the tools together. Don't rely on just PCR or just IV. Look for confirmation across multiple indicators, PCR, IV, max pain, Greeks, to build a stronger case.
Holistic view.
Right. Third, beware of holding options too close to expiry. That theta decay accelerates massively in the last few days or hours. It can wipe out value incredibly fast.
To get out before the final countdown.
Often wise, unless it's part of a specific expiry strategy. Fourth, use the tools available. Your broker platform, sites like Sensible, they provide a lot of this data, PCR, IV, max pain, readily. Leverage them.
Don't reinvent the wheel.
Definitely not. And lastly, maybe most importantly, paper trade first. Practice these strategies. Test this analysis using simulated money before you risk your real capital.
Practice makes, well, less likely to lose money cruelly.
Something like that. Gain experience, test things out, build confidence in a risk-free environment.
Invaluable advice. Okay, so wrapping this up. The key takeaway seems to be that Nifty options trading isn't just guesswork. It involves understanding and actively using this whole toolkit of interconnected indicators.
That's right.
PCR, IV, max pain, synthetics, Greeks. They all provide different pieces of the puzzle about sentiment, volatility, potential price paths. This deep dive, using Mansi Ma'am's tutorial as a guide, hopefully provided a framework for how you can put these pieces together in a structured way.
Exactly. And it's really just a starting point. Options are complex, markets change, so continuous learning, practice, adapting.
Yeah.
That's absolutely essential if you want to navigate this space successfully over the long run.
Definitely a journey, not a destination. So, with that, here's a final thought for you to consider. How does this kind of structured, data-driven approach, constantly monitoring these different indicators and their interplay, how does that compare to maybe a more intuitive gut feel or purely chart-based trading style? What might be the pros and cons of each? And could you perhaps blend elements of both in your own approach to the market? Something to think about. We encourage you to explore further and maybe even try some paper trading to see these concepts in action. Thanks for joining us for this deep dive.